What if I told you that a narrow strip of water halfway across the world is quietly raising your fuel bill, squeezing your business margins, and stressing out India's entire economy? Right now, here's what's going on. The Strait of Hormuz, this tight, almost uncomfortably narrow waterway in the Middle East, has been disrupted. And that matters because roughly 1/5 of all the oil that moves on this planet passes through it every single day. Every single day. Think of it like one highway carrying 20% of every good into your city suddenly getting blocked. Prices spike, shortages follow, and panic does the rest. That's not a metaphor. That's your infographic right there. One choke point, 20% of global oil flows, gone. The result? Brent crude. That's the global benchmark price for oil. Has now surged to $125 per barrel. Which sounds like a Wall Street problem, until you remember that India imports over 85% of its oil needs. 85%. So when that global price jumps, our import bill doesn't creep up. It balloons almost immediately. A sustained price at this level directly widens India's current account deficit. That's the gap between what we're paying the world versus what the world is paying us. A wider deficit puts pressure on the rupee. And a weaker rupee means everything imported. Electronics, raw materials, components your factory runs on, gets more expensive for you. Now here's where it gets interesting. India hasn't just been sitting around watching this happen. Since 2022, we've been quietly and quite aggressively diversifying our oil sources, leaning hard into discounted Russian crude. That strategic pivot? It's paying off right now. Indian refineries are still running. Domestic fuel supply hasn't collapsed. The price shock is being partially absorbed before it even reaches your petrol pump. And on the monetary side, HSBC, one of the world's largest banks and a serious India macro forecaster, predicts the Reserve Bank of India will hold its repo rate steady in June 2026 rather than hiking it further. The repo rate, just to be clear, is the rate at which the RBI lends to banks, which is basically the dial that controls how expensive your loans get. Instead of hiking, the RBI plans to inject liquidity, pump more money into the banking system to keep credit flowing and the economy breathing. So yes, the shock is real. But India has more shock absorbers in place than most people are giving it credit for. But absorbing a shock is only half the story. The real question is, what exactly is the government's playbook to fight back? Because HSBC's economist says there's a very specific three-pronged strategy on the table. Let's break that down next. So what's the government actually doing about it? Turns out, quite a lot. And depending on what sector you're in, this either saves you or squeezes you. The government is playing three cards at once. First, credit guarantee schemes for small and medium businesses. If you've been trying to get a working capital loan and banks keep ghosting you, the government is now essentially co-signing that loan. It reduces the bank's risk, so you're more likely to get approved and at a better rate. Short-term lifeline? Yes. Long-term fix? Only if the oil shock doesn't drag on. Second card. NREGA, the Rural Employment Guarantee Program, is being ramped up hard. And before you dismiss that as not my problem, think again. Rural India is a massive chunk of your consumer base. If rural incomes hold, demand doesn't fall off a cliff, and your sales don't crater with it. Third, and this is the big one you can see right there on screen, an $800 billion public infrastructure investment wave. Roads, ports, railways, the works. If you're in construction or infrastructure, L&AMP-T, Adani Ports, NHAI. This is a direct win for landing in your lap, and quietly winning alongside them. Renewable energy firms, Suzlon, Tata Power, Adani Green. When oil gets this expensive, the switch to solar and wind stops being an environmental talking point and starts being an economic no-brainer. Geopolitical pressure is doing what years of climate summits couldn't. But not everyone's popping champagne. Oil marketing companies, HPCL, BPCL, IOC, are getting crushed. The government is keeping pump prices capped to shield consumers, which sounds great at the petrol station, but it means these companies are selling fuel below cost. That gap is called an under-recovery, and it's bleeding them dry. Airlines, auto companies, logistics operators. Same story. Fuel costs are eating straight into margins. If you run any kind of transport or delivery business, you already know exactly what this feels like. So the government's moves are real, but they're not evenly distributed. Next, we'll get into what this all means for inflation and the broader outlook going forward. Now here's the part that most people are completely sleeping on, because the headline numbers actually look decent right now. So what's the catch? India's manufacturing PMI climbed in April 2026. And yes, above 50 means expansion, so that sounds like good news. But HSBC is basically saying, don't pop the champagne yet. That rise wasn't driven by real demand. It was driven by front-loading. Producers rushing to stockpile goods and raw materials before energy costs got worse. Think of it like a student who blasts through every assignment in the first 2 weeks of the semester. Their midterm report looks brilliant. But the second half, empty. That's the setup right now, once those stockpiles get burned through. And if oil stays brutal, production slows hard, and the real damage becomes visible. HSBC is already flagging a risk of a production slump in Q3. And if you're a manufacturer or supplier, April's numbers should not be making you comfortable. Plan for a softer quarter, not a stronger one. On the inflation side, sustained oil at $125 a barrel keeps squeezing everyone. Corporate margins, household budgets, all of it. Right now, the government is absorbing the hit, kind of like a restaurant owner who refuses to raise menu prices even though his ingredient costs have doubled, just to keep customers walking in. Smart short-term move. But it cannot last forever. Either those costs get passed on to consumers, hitting your input costs and your customers' wallets at the same time, or the fiscal deficit starts to balloon dangerously. So here's what you actually watch. Brent crude staying above $110 for more than 60 consecutive days is where India's fiscal math starts breaking down. And any signal from the RBI of liquidity tightening after June 2026 means the cushion is being pulled away. Until then, use the window. Credit guarantees, lower borrowing costs. They're there right now. Strengthen your balance sheet while you still can, because this calm has a shelf life. That wraps this breakdown. The strategy, the risks, and the numbers to watch. Stay ahead of the curve. Follow us for more updates like this. Thanks for watching. And don't forget to follow us on YouTube, Instagram, and X.